Hello, this is Leroy Meadows, and in this session we're going to be working on an exercise regarding the flexible budget. And this exercise is at the end of the chapter. This is exercise 7-21. So exercise 7-21 is at the end of the chapter here. So let's go ahead and get started working this example. Sweeney Enterprises manufactures tires for Formula One motor racing circuit. For August 2017, it budgeted to manufacture and sell 3,600 tires at a variable cost of $71 per tire and total fixed cost of $55,000. The budgeted selling price was $114 per tire. Actual results in 2017 were 3,500 tires manufactured and sold at a selling price of $116 per tire. The actual total variable costs were $280,000, and the actual total fixed costs were $51,000. So we're asked to do two things: prepare a performance report, similar to the one in Exhibit 7-2 in your book. And if you need to go ahead and pause the video to look at that exhibit, please go ahead and do so. But we need to prepare a performance report that uses the flexible budget and a static budget. And then second of all, we're going to comment on the results in requirement 1 and discuss those. So the first thing we want to do is plan out our master or static budget. How much did we actually plan to sell before the beginning of the period? And we're actually just looking at August 2017. So how many units did I plan on selling in August 2017? Well, I planned on selling 3,600 tires. Now, my revenues, based on that budget of 3,600 tires selling, how much revenues did I budget for? Well, I budgeted for a selling price of $114. So I'll put that down here, and I'm going to keep track of my prices here because I want to do an analysis of this. So my budgeted selling price was $114, and I was going to sell 3,600 units. So how much revenue was I going to create? Well, $3,600 times 3,600 units times $114 sales price per unit. That should give me $410,400 of revenue. Now let's take a look at our variable costs. And in this example, we're just combining our variable costs of direct materials, direct labor, and manufacturing overhead into one line item. So let's take a look here. What were my budgeted variable costs per unit? Let's see, $71. So I'm going to put this in my little information table here. And so if I sell 3,600 tires, and it's going to cost me with variable costs $71 each, how much cost am I going to incur with associated with the making of the tires? Well, I'm going to incur costs of $255,600. And let me go ahead and format this here. So what is my contribution margin? So we remember the contribution margin is simply revenues minus variable costs. So let's calculate our contribution margin. And our contribution margin, our budgeted contribution margin, was $154,800. Now, remember that when we talk about fixed costs, we want to focus on the total fixed costs when we're doing budgeting. The goal is to look at total fixed costs. Unlike variable costs, where we'll compute a variable cost per unit and to do an analysis, fixed costs we want to deal with in total. So what was my budgeted fixed cost in total? It was $55,000. So remember now, 55,000. So I was going to budget operating income of contribution margin minus my fixed costs. And so my budgeted operating income was going to be $99,800. Now, let's take a look at our actual results. My actual results. How many units or how many tires did I sell? Well, the problem says I sold 3,500 tires. So I'm going to go ahead and put that in there. And let me go ahead and format these cells now. And my actual selling price, what was my actual selling price per tire? Well, it was $116. I'm going to just put that there because I want to list that price separate. I want to do an analysis later on to see if I can get any insight into what's going on with the different variances. So what were my actual revenues? Well, my actual revenues is simply going to be the actual number of units sold, and that was 3,500 times my actual selling price. So when I take my actual number of units sold, 3,500, multiply that by my actual selling price of $116, I actually had $406,000 worth of revenue. Now, let's take a look at variable costs. Now, in this example here, they gave us total variable costs of $280,000. So, since I don't need to actually compute the actual variable cost per unit or to use it because they gave me the total. I do want to get that actual variable cost per unit though, because I want to make an analysis later. So, but what are my total variable costs? My total actual variable costs are $280,000. So what was my actual contribution margin? It's my actual revenues minus my actual variable costs. And my actual contribution margin was $126,000. Now, from that, I'm going to subtract out my actual fixed costs to get my actual operating income. What were my actual fixed costs? They were $51,000. So my actual operating income was $75,000. Now, at this point, we can, before we go any further, we can do the level 1 analysis and just take my actual results minus my static budget result to get my total static budget variance. And what is that? Well, my static budget variance is simply going to be $99,800 minus $75,000. So $99,800 minus $75,000 gives me $24,800. Now, is that a favorable variance or an unfavorable variance? Well, remember that the favorable variance are any line items that when we take a look at it and just isolate that line item, a favorable variance increases operating income, whereas unfavorable variance decreases operating income. In this case, we had a decrease in operating income. We budgeted for $99,800, but our actual results were $75,000. So my total static budget variance is $24,800 unfavorable. Now that I have my static budget, I am going to now create and do the next level of analysis, a level 2 analysis, and create my flexible budget. So now let's create our flexible budget. Remember, our flexible budget is really taking our actual units sold and multiplying them by our budgeted amounts, our budgeted selling price, and our budgeted variable costs. So my flexible budget is going to be based on 3,500 units, but we're going to base it off our static budget of budgeted selling price and budgeted variable cost. And the flexible budget, if you remember, is nothing more than the budget we would have actually created had we had our psychic abilities going on and we could predict exactly how many units we were going to sell. Now, do we know exactly how many units we're going to sell the next period? No, we don't, which is why we create a master budget. It is an estimate, our best estimate, but not everything works out quite that way. So our flexible budget is going to help us to create an apples-to-apples comparison, because in this analysis of level 1, when I'm just doing my static budget variance, I'm comparing $75,000 worth of operating income versus my budgeted amount of $99,800. Now, is that good? No, it's unfavorable, but why is it unfavorable? Well, if we sell less, then, and in this case we sold 100 units less, then I would expect my operating income to be down because I sold less units. However, are my results actually bad? We won't know until we do an apples-to-apples comparison, and that's where the flexible budget comes in. So my flexible budget, I am going to take, and for each one of the line items for revenues and variable costs, I'm going to take my flexible budget amount of units sold, which is always the same as the actual units sold. So I'll take my budgeted unit sold, my flexible budget unit sold, and multiply that, or my actual unit sold times my budgeted selling price of $114. And the $399,000 is the amount of revenues that I would have predicted if I knew I was going to sell 3,500 tires and not 3,600. So now what would I have predicted for variable costs if I knew I was only going to sell 3,500 tires and not 3,600? Well, I'm going to take the 3,500 tires that I sold and multiply that by my budgeted variable cost per unit of $71, and I would get a variable cost of $248,500. So my contribution margin then, I would have budgeted to be $150,500. Now my flexible budget is for fixed costs is always going to be the same as my static budget. So that's going to be $55,000. Why is that? Because for fixed costs, we're paying for capacity. There is no fixed cost per unit that changes. I mean, the fixed cost per unit change, but the total cost should not change as long as we're operating within that relevant range, and we are assuming that we are. So at various levels of activity, as long as we're in that relevant range, fixed costs should remain the same. So my fixed costs here are going to be the same as my static budget of $55,000. So based on selling 3,500 units, I should have had operating income. Take out my contribution margin minus my fixed costs. I should have had operating income of $95,500 based on my budgeting input and sales price, and then my actual units sold. Now I have a comparison. Now I can take and figure out did I do better or did I do worse? First of all, let's take a look at the sales volume variance. Now, for both the static budget and the flexible budget, here on the right-hand side, here in the middle on the right-hand side, these are based on budgeted selling price and budgeted variable cost per unit, so that stays the same. So what is the difference between the flexible budget and the static budget? Just simply the number of units sold. So the sales volume variance is only generated because there's a difference at the sales level. Remember, my budgeted selling price and my budgeted variable cost per unit are the same for the static budget and the flexible budget. So if they're the same for both, then that cannot be the cause of the variance. So I had to figure out what else does that cause. Well, the only thing that changed was my actual units sold. So I'm going to have 100 unit difference, and I'm going to label that as unfavorable. So now let's take a look at our revenues. And my revenues for my sales volume variance is going to be simply my static budget minus my flexible budget. So in this case, if I take my static budget of $410,400 and subtract that from the flexible budget revenues of $399,000, I have an $11,400 difference. Now, is that a favorable variance or an unfavorable variance? Well, all else being equal, because we're just looking at these one individual line items, all else being equal, a reduced amount of revenue is going to lead to a reduced amount of operating income. So I'm going to classify that as an unfavorable variance. And let me go ahead and format this column real quick. There we go. Now, based on my cost, based on my sales volume variance, which is the difference between the static budget and the flexible budget, what is my sales volume variance for variable costs? Well, if I'm just going to take the difference between my flexible budget amount and my static budget amount, so that is $255,600 and $248,500. So I have a $7,100 difference. So let me put that in here. Now, is this variance favorable or unfavorable? Well, if I'm just looking at this one line item, if variable costs decreased, then all else being equal, my operating income should increase because an increase in cost will lower income, a decrease in cost will raise income. So if I have a difference in cost here, my flexible budget is actually lower than my static budget, then all else being equal, I should have higher operating income. So we would classify that variance as favorable. Now let's take a look at my static budget variance, or my contribution margin variance. And what is that? Take the difference between 150,500, 154,800, and that would be 4,300. And again, contribution margin, is that favorable or unfavorable? Well, lower contribution margin, if I'm just looking at this one line item, lower contribution margin in and of itself, with all else being equal, will lead to lower operating profit. So we're going to classify that as unfavorable. And we can also calculate the contribution margin by just combining these two sales volume variances here. So we can actually compute the contribution margin and sales volume variance two ways. Take the difference between the flexible budget contribution margin and the static budget contribution margin, or net out the effects of the sales volume variance of the revenue and all the variable costs associated with that. Now let's take a look at our fixed costs. Now our fixed costs, because we're paying for capacity, and within that relevant range, total fixed costs should not change. This goes back to our understanding of cost behavior. Fixed costs in total do not change, and that since that's what we're focused on, fixed costs in total, there should never be a sales volume variance for fixed costs. So what is my total sales volume variance? $4,300. 4,300 up here, contribution margin minus 0 is $4,300 unfavorable. So I'm going to put this over here. Now, let's take a look at our flexible budget variance. Now, the computer flexible budget variance, we have to remember that the flexible budget is based on actual results. So there should never be a flexible budget variance for the number of units sold between that and the actual results, because our flexible budget is based on actual units sold. So I should never have a flexible budget variance for the number of units sold. Now, let's take a look at our individual items here for revenues. Based on selling 3,500 tires, I should have generated $399,000 worth of revenue. However, I actually generated $406,000 worth of revenue. So is that good or bad? Well, it's good, because based on selling 3,500 units, I actually created an additional $7,000 of income. So my flexible budget variance is going to be $7,000 and then favorable. Again, because this one line item, revenues increase, all else being equal, and then an increase in revenue is going to equal an increase in operating income when we're just looking at those amounts. So let me go ahead and format the column here. Now let's take a look at our variable costs. For making and selling 3,500 units, I should have only incurred variable costs of $248,500. But my actual variable costs were $280,000. Is that good or not good? It's not good, because I should have only had this much in variable costs associated with selling 3,500 units, but I actually incurred $280,000. So I'm going to take the difference, and since my cost came in higher, all else being equal, it's going to be an unfavorable variance because we're reducing operating income with all else being equal. So $280,000 minus $248,500, and my flexible budget variance for variable costs is $31,500 unfavorable. So what is my contribution margin? Well, my contribution margin, remember I said I can do this two ways. I can take the contribution margin from my actual results and the difference from that in my flexible budget, or I can simply combine the contribution margin or I can combine the revenues and variable costs and net the effect and get that also. And let's just do that. Let's see. 7,000 favorable minus 31,500 unfavorable. And so I have contribution margin income. The difference is 24,500. Is that favorable or unfavorable? Well, it's unfavorable because I should have had $150,500 with the contribution margin, and my contribution margin was only $126,000. So that's going to be unfavorable. Now, let's take a look at my fixed costs. Well, my fixed costs is simply going to be the difference between my flexible budget and my actual results. And my fixed cost actually came in $4,000 less. So for costs coming in $4,000 less, that's going to be a $4,000 favorable variance. And then I'm going to take my, I can actually just do it either way, take my difference in operating income under actual results, subtract that, and then find out the difference between that and my flexible budget. And I'm going to go ahead and do it this way for this one. So 95,500 minus 75,000. And the difference in operating income I should have had making 3,500 units at 95,500. Since my operating income was only $75,000, I have a $20,500 variance, and that is going to be what? Unfavorable. Why? Because my operating budget came in, or my operating income came in under what I should have had based on the actual level of sales that I had. So I have my sales volume variance over here, 4,300. I have my flexible budget variance of 20,500, unfavorable. And what do I notice? I notice here that my sales volume variance here, 4,300 unfavorable, netted and combined with the effects of my flexible budget variance of 20,500 unfavorable, will give me my static budget variance. So when I take my sales volume variance, add that to my flexible budget variance for operating income, then that will give me the total static budget variance for operating income. So when I net those two together, I will get the static budget variance here. So now let's do number 2 and comment on the results in requirement 1. So let's take a look here and let's fill in our little table here. We had a budget cost of $55,000 and actual fixed cost of $51,000. Let's actually compute the variable cost per unit. So I had 280,000. It gave us the total variable cost divided by 3,500 units that we sold. And my variable cost came in at $80 per unit. So now let's do an analysis here. What can I determine from the numbers here? Well, my actual selling price did increase by $2 per unit. So that helped. And that's why we see a $7,000 variance. However, my budgeted variable cost per unit of $71 came in less than my actual variable cost of $80 per unit. So that contributed to the $31,500 unfavorable flexible budget variance. So in other words, I had my actual cost per unit for came in $9 higher than what I had budgeted per unit. Now, some of that was offset by a $2 increase in the actual selling price, but it was not enough to overcome. So hence we have unfavorable contribution margin and the fixed costs coming in less than what they should have at this level of sales. That helps to lower the difference also, but we also have, but not enough to actually give us a favorable operating income variance. So this is an analysis here. So now remember, the sales volume variance arises solely because of the change in sales volume between our static budget, what we budgeted to sell, and the number of units we actually sold. And we know that it's only based on sales volume because the flexible budget and the static budget are all based on the budgeted selling price per unit, budgeted variable cost per unit, and our budgeted total fixed cost. So the only thing that changes is the actual number of units sold. So that is the cause of our sales volume variance. It's only because of a change in sales volume. The flexible budget results not as a change in sales volume when I'm comparing my actual results versus flexible budget, because they're both based on the same number of units sold. So, because again, my flexible budget is based on actual number of units sold, but then I'm computing what my revenues and variable costs should have been based on my budgeted selling price and input cost per unit for variable costs. So, my flexible budget variance then is primarily due to the change in the actual price of the selling of the sales price and the actual change in the variable cost per unit, and then to some degree our total fixed costs that we incurred. So while this sales volume variance is based only on the change in the level of activity between what we budgeted and what actually occurred, the flexible budget variance is due to actual revenue price, sales price per unit, variable cost per unit, and the difference in fixed costs in total. So that is exercise 7-21. This is Leroy Meadows. I want to thank you for being here with me, and you have a